This week, the United States government is holding one of the biggest financial auctions on the planet. It's selling $119 billion in new debt, a mix of $58 billion in 3-year notes, $39 billion in 10-year notes, and $22 billion in 30-year bonds. Think of it like this. When the U.S. sells bonds, it's asking the world for a loan, promising to pay it back later with interest. These auctions usually happen quietly, almost like background noise in the global economy. But this time, the world is paying very close attention. Because this isn't just another auction, it's a test. A test of whether people still believe in America's financial strength. Imagine a company that's always been considered rock solid, suddenly having trouble finding investors. That's the position the U.S. could be in right now. Every country, every pension fund, every central bank that buys U.S. debt is placing a bet that America will always pay what it owes. But here's the unsettling truth. There are signs that the world is starting to hesitate. Investors who once saw U.S. bonds as the safest place to park their money are beginning to question whether that's still true. If confidence starts to crack, it could shake the foundation of the entire global financial system. Because U.S. debt isn't just American, it's the backbone of international trade, banking, and trust. So the real story this week isn't just about $119 billion in government bonds. It's about something much bigger: trust. Trust in America's promise to pay, trust in its financial leadership, and trust in a system that has quietly kept the world running for decades. For decades, the United States could always count on the rest of the world to buy its debt. Foreign governments, especially big players like Japan, China, and European central banks, used to line up for U.S. bonds. They saw them as the ultimate safe investment, a place where their money could rest securely while earning steady interest. But something has changed. Quietly and steadily, foreign buyers are pulling back. They're not completely leaving, but they're changing what they buy. And that shift says a lot. Instead of long-term U.S. bonds that mature in 10, 20, or 30 years, they're now loading up on short-term Treasury bills, which mature in less than a year. That might sound like a small difference, but it's actually a big deal. Long-term bonds are a symbol of trust. They mean, we believe in America's stability for decades to come. Short-term T-bills, on the other hand, mean, we'll lend you money, but only for a few months. After that, we want the option to get out. It's like a landlord who used to sign a 10-year lease, now insisting on month-to-month rent. It's flexibility, but it's also a warning. They're keeping one foot out the door. Why? Because the world is starting to worry about America's long-term financial health. The U.S. keeps piling on debt while fighting inflation, running massive deficits, and facing political gridlock that makes serious budget reform look impossible. For foreign investors, that's a red flag. To them, the math doesn't add up. If debt keeps climbing faster than income, eventually the trust that backs that debt begins to fade. So they're protecting themselves, moving their money where it's safer and more liquid. This global hesitation is more than just a shift in investment strategy. It's a warning signal, a flashing red light that says the rest of the world no longer wants to bet on America's long game. When foreign buyers start to retreat, someone else has to fill the gap. Otherwise, bond auctions could fail, meaning the U.S. government might not raise enough money to fund itself. So who's stepping in? Recently, all signs point to one familiar name: the Federal Reserve, America's central bank, the lender of last resort. But what's strange this time isn't that the Fed is buying bonds, it's how it's doing it. In early reports, analysts noticed something unusual. Over just 4 days, the Federal Reserve quietly bought about $43.6 billion worth of U.S. Treasury securities. There was no big announcement, no press release, no public statement. It simply appeared in the data. At first glance, that might not sound dramatic. Central banks buy and sell bonds all the time. But this wasn't part of the Fed's normal daily operations, like adjusting liquidity or managing short-term rates. Instead, it looked eerily similar to something from the past, quantitative easing, or QE, the massive bond buying programs used during the 2008 financial crisis and the pandemic to stabilize collapsing markets. Only this time, it wasn't officially called QE. It was quiet, hidden in plain sight. No explanation, no headlines, just silent buying. So why keep it secret? Because admitting it openly would send a dangerous message that private investors aren't buying enough U.S. debt and the government is having to prop up its own market. That would suggest that demand for America's bonds is weaker than anyone wants to admit. Think of it like a concert where the audience starts leaving and the organizer pays people to stay and clap so the room doesn't look empty. The applause continues, but the energy isn't real anymore. If the Fed has to quietly step in just to keep bond auctions running smoothly, it raises a chilling question. What happens when the real crisis hits? Because if demand is already fading during normal times, what will the government do when investors truly panic? The real problem isn't just what's happening this week, it's what's coming next year. A debt avalanche unlike anything the United States has ever faced. In 2025 alone, the U.S. government will have to refinance about $9.2 trillion in debt. That means trillions of dollars in old bonds, many issued when interest rates were near zero, will expire, and the Treasury will have to sell new ones to replace them. But here's the catch. Those new bonds will come with much higher interest rates. To picture this, imagine refinancing your home. A few years ago, you might have had a 2% mortgage. Now, when you renew, it's closer to 7%. You're not borrowing more, you're just paying a lot more interest for the same amount of debt. Now multiply that by 9 trillion. That's the situation facing the United States. This rolling wave of debt puts enormous pressure on the Treasury and the Federal Reserve. Investors know the government needs to issue record amounts of new bonds just to keep the lights on, not to fund new projects, but simply to replace the old debt that's expiring. And when the market senses desperation, it demands a higher price. In bond terms, that means higher yields. We're already seeing the warning signs. Recent bond auctions are struggling, foreign demand is down, yields are spiking. That means it's costing the government more and more just to convince investors to buy. And this isn't just about liquidity or cash flow, it's about confidence. The United States is supposed to be the one borrower in the world everyone can trust, the one that never has to worry about rolling over its debt. But when investors start doubting even that, it shakes the foundation of the global financial order. This debt avalanche is more than a math problem. It's a psychological one. Every auction, every new bond issued is another test of faith. And if that faith continues to erode, it could trigger something far larger, a shift in how the world values American debt altogether. If there's one thing markets never lie about, it's numbers. And lately, the numbers tell a story that should make Washington nervous. Recent U.S. bond auctions, the events where the government sells its debt, have started showing serious warning signs. Take the 30-year bond auction. Wall Street dealers, who act as middlemen in these sales, were forced to buy about 18% of the total supply. That's the largest share they've had to absorb since 2021. In plain English, that means end buyers, foreign governments, pension funds, and major investors, didn't show up in the usual numbers. The same pattern appeared in the 20-year note auction, where the bid-to-cover ratio dropped to 2.43, one of the lowest in years. That ratio basically measures how many bids come in compared to how much debt is available. A high ratio means strong demand. A low one means buyers are getting cold feet. Meanwhile, the 10-year yield, often called the heartbeat of global finance, jumped to around 4.7 to 4.9%, its highest point since before the 2008 financial crisis. When yields go up, it means investors are demanding more reward, and that's because they see more risk. It also means that the prices of existing bonds fall, creating losses for anyone who already owns them. So what's driving this? A growing sense that U.S. debt isn't the no-brainer it used to be. Back in 2012, foreign investors held over half of all U.S. treasuries. Today, that number has fallen to roughly 22 to 23%. That's a massive pullback in just over a decade. China, once America's second-largest lender, has reduced its holdings to just about $760 billion, the lowest in more than 10 years. Japan, still the biggest holder, is also trimming its purchases as the interest rate gap between Japanese and U.S. bonds shrinks. As these foreign giants back away, the U.S. government is forced to rely more on domestic buyers, banks, funds, and private investors at home. But their money isn't endless, and they're demanding higher returns to keep lending. That drives interest rates higher, feeding the cycle of rising borrowing costs. It's a quiet but powerful shift. The world's trust in U.S. debt is no longer automatic. The auctions that once ran smoothly have turned into stress tests for the global economy. And as yields rise and trust erodes, the impact won't stay locked inside financial charts or trading floors. It's already leaking into everyday life through mortgages, car loans, and the cost of doing business. When people hear about bond yields rising or debt auctions struggling, it can sound distant, like something that only affects traders on Wall Street. But in reality, what happens in the bond market eventually lands right on Main Street. Here's how it works. The interest rate on U.S. government debt sets the tone for almost every other kind of borrowing, from mortgages and car loans to credit cards and corporate financing. So when Treasury yields climb, the cost of borrowing across the economy climbs with them. And that's exactly what's happening right now. Just a few years ago, in 2021, the average interest rate the U.S. government paid on its debt was about 1.6%. Today, it's 3.3%, more than double. That might not sound dramatic, but remember, this isn't a family credit card bill. This is $36.9 trillion of national debt. If that rate continues to rise, the U.S. could soon spend over $1.1 trillion every year just on interest payments, more than it spends on national defense, and more than Medicaid. Imagine paying more on your credit card interest than your rent, food, and transportation combined. That's where America is headed. And as the government spends more just to service old debt, there's less money left for everything else: infrastructure, education, research, or emergency relief. The more it borrows, the more it owes in interest. The more it owes, the harder it becomes to keep borrowing cheaply. It's a dangerous feedback loop, a vicious cycle of debt feeding on itself. But the pain doesn't stop with Washington. Rising Treasury yields push up mortgage rates, which are already hovering around 7%, making it harder for families to buy homes. Car loans are more expensive, and credit card rates are hitting new highs. Businesses that once refinanced easily are now struggling to roll over their debt, cutting jobs or delaying investments. This is where the so-called bond vigilantes return. Investors who punish reckless government spending by selling off bonds, forcing yields even higher. They've done it before, and it looks like they're back. Their message is clear. If you keep overspending, we'll make it cost you. So, what began as a technical problem, weak demand for Treasury bonds, has become something much bigger, a shift in economic power. The bond market, once a silent partner to Washington, is now setting the terms. It's no longer just the government deciding how much to borrow. The market is deciding what price that trust will cost. And that growing tension between policy and reality is bringing the U.S. to a crossroads, one that even the Federal Reserve can't easily escape. The Federal Reserve now finds itself trapped between two equally dangerous options, and whichever path it takes could reshape the entire U.S. economy. On one side, the Fed has spent the past few years trying to fight inflation by keeping interest rates high and reducing its balance sheet, a process called quantitative tightening. That strategy makes borrowing more expensive, slowing spending, and helping bring prices under control. But on the other side, those same high interest rates are now threatening to break the very system they were meant to protect. The bond market is wobbling, government borrowing costs are exploding, and demand for treasuries is thinning out. So the Fed faces two bad choices. If it steps in to buy bonds again, in other words, print money to stabilize the market, it could reignite inflation that Americans have only just started to recover from. Prices could climb again, hurting consumers and destroying the Fed's credibility as an inflation fighter. But if the Fed does nothing and continues to tighten policy, bond yields could spike even higher. That would cause borrowing costs across the economy to soar, crush the housing market, and send parts of the government's budget spiraling out of control. It's the definition of a lose-lose situation. Behind closed doors, according to reports, officials at the Fed are already discussing contingency plans, emergency repo operations, a pause in tightening, or even a quiet return to quantitative easing by September if auctions keep failing. Each option comes with major consequences, and the political backdrop only makes things worse. Congress has just passed another $2.4 trillion tax and spend package, adding fuel to the debt fire. Meanwhile, policymakers in Washington keep talking about new programs and incentives, even as the borrowing bill grows larger every day. So now, the Fed, an unelected institution, is being pushed into a corner. It can either protect the bond market or protect its credibility. It cannot do both. For the first time in decades, it's not Washington calling the shots. The market is. The people who buy America's debt are effectively dictating policy. And this is where the story takes a darker turn. Because when markets start steering national policy, it signals something far more serious, a loss of control over the country's economic future. What's happening right now isn't just an economic event, it's a geopolitical turning point. For decades, America's financial power rested on one simple fact: the world trusted the US dollar and the US bond market more than anything else. That trust gave Washington unmatched global influence. But that foundation is starting to crack. The shift didn't happen overnight. It's been building through years of trade wars, political gridlock, and financial overreach. And now, the consequences are becoming impossible to ignore. When the White House launched new rounds of Liberation Day tariffs on China, meant to look tough on trade, it had an unexpected effect. It rattled the global bond market. Investors saw it as a sign that the U.S. was willing to weaponize economic policy, even if it caused collateral damage. Confidence wavered, and yields jumped. Around the world, countries that once depended on the dollar system began looking for alternatives. Some turned to gold. Others started experimenting with digital currencies or bilateral trade deals that bypassed the U.S. altogether. It's not a sudden revolt, but a slow erosion, like sand slipping out from under the world's financial anchor. And here's the irony: the U.S. built its global power not through force, but through trust. The belief that its money was stable, its markets were fair, and its debts were sacred. But now, the same financial machine that projected strength is starting to expose weakness. Bond traders, not politicians, are steering America's future. Every move in the yield curve sends ripples through global currencies, stock markets, and central banks. Policy is no longer made just in Washington or the Fed. It's being dictated by the invisible hand of a market losing patience. So, we circle back to the question that started this story. What happens when the world stops trusting America's promise to pay? Because if that trust fades completely, the consequences go far beyond higher interest rates or bad auctions. It means a loss of sovereignty, the moment when financial markets, not elected leaders, decide how the U.S. must act. That's the real risk. Not default, not collapse, but dependence. Dependence on the same investors the government once took for granted. And that brings us to the final, sobering truth. Trust is the currency of nations. Once it's broken, no printing press can bring it back. So stay informed. Stay critical. Because every bond auction, every Fed meeting, every policy decision from here on out isn't just about numbers. It's about belief. And the clock is ticking. The next auction could decide America's financial fate.